Luke, did those comments sway you in any way, or does this feel like it's a situation where the markets are still trying to suss out what future Fed policy could look like in a Trump administration?
Well, so firstly, morning, Dom. I think for us, we've been constructive on risk assets and equity markets specifically. And I think what we're seeing coming out of the most recent US election is just optimism that we're going to see a continuation of the growth dynamics in the US. And so anything that takes away a little bit of the anxiety or some of the risks associated with what is the new policy going to look like in the new year is going to be supportive of that. But the underlying fundamental picture still remains healthy. And I don't think that's being particularly impacted by some of these comments we've seen recently.
All right, so if you're saying that the Trump comments have taken a little bit of the uncertainty out of the equation right now, what exactly then will be the crux or the main force of the Fed investing philosophy or the Fed investing, I guess, take? Do we have to see interest rate cuts continue in the new year, and how many do we have to see?
Also, I think we're very likely to see continuation of normalization of policy. I think that December cut is highly likely, as you've already stated. I think our expectation for next year is we'll see another 25 basis point cuts, get us down to something in the 3.5, 375 range. Now, I think the reality is that's very different to where we were even 6 months ago. The expectation of over 200 basis points of cuts from the Fed was really what buoyed optimism and sentiment in the middle part of this year. We've seen that normalize as the Fed has put a little bit more caution behind some of their recent comments, recognizing that maybe there are some inflationary forces on the horizon. But again, when we look at the underlying growth dynamic and we're seeing trend growth still north of 2% and the prospect of that moving higher into next year, that is really driving fundamentals and corporate earnings, which we think underpins the equity opportunity within the US.
Luke, that sounds like it's a rising tide and it lifts all boats, but some boats will rise faster than others. What exactly then is the play? Is it going to be in this broadening out trade that you referenced? Is it going to be back in those Magnificent Seven type mega cap stocks? Where do you think the opportunities are?
So we do think just staying invested in equity markets is the right way to play this, but we do see this broadening opportunity set. And as you referenced, this broadening of growth across the US, specifically into the smaller cap space, and that catch-up trade for US smaller caps is where we're seeing the most opportunity. And let's just put that into context. One, you do have this normalization of policy from the Fed that does feed through to margins. This is a more leveraged and often floating rate debt asset class. And so as you see rates come down, that feeds straight to bottom line for a lot of the small cap cohort. And maybe we're not going to see rates move as quickly down as we saw or expected in the middle part of this year. But the counter to that is that we're going to see growth pick up even more accelerated than we expected. And so that's feeding this domestic demand dynamic for smaller caps. And given you've had this historically high spread in valuation, small cap versus large cap, you've had this very narrow market dynamic with a subset of mega cap names really driving the outcome. We think that catch-up trade can be very strong for the smaller cap space. That doesn't mean we don't still find select opportunities in the large cap space, but definitely just that normalization of multiple and a little bit of consolidation across the large cap space we think is likely as we go into next year.